It didn't begin with a war between man and machine, or a robot taking someone's job. It began with a trade. Silent, instant, invisible. Somewhere inside a server farm in New Jersey, a machine executed a decision faster than a neuron could fire. In that moment, billions of dollars shifted between accounts, and no one, not a banker, not a trader, not even a regulator, truly understood why. The AI revolution did not start with machines replacing labor. It began with machines replacing judgment. To trace that transformation, we must go back to the 1970s and 1980s, when the world's financial system was still human. Traders shouted across crowded floors. Deals were made by phone, rumor, and instinct. But after the oil shocks and inflation of the 1970s, Wall Street turned toward mathematics. The rise of computing offered an escape from emotion, a promise that markets could be tamed by logic. Firms like Salomon Brothers, Morgan Stanley, and Goldman Sachs hired physicists and programmers to translate uncertainty into equations. In 1987, that faith met its first reckoning. The Black Monday crash of October 19, 1987, remains the sharpest one-day drop in stock market history, a fall of 22% in hours. The cause wasn't panic alone, it was automation. Portfolio insurance algorithms designed to limit risk by selling as prices fell, instead amplified the collapse. Machines sold because others were selling. Feedback loops turned protection into destruction. The first lesson was written: systems built to prevent crashes could cause them. Still, the future belonged to code. In the 1990s, a new breed of financial institution emerged: quantitative hedge funds. Renaissance technologies, founded by mathematician James Simons, became their model. Simons's team of linguists, astronomers, and computer scientists built black boxes that found hidden patterns in oceans of data. They ignored earnings reports and intuition, relying on probability, not psychology. The Medallion Fund would later average returns above 60% per year, unseen in financial history. Wall Street learned that algorithms didn't need to understand the market to dominate it. They just needed to predict it. As the internet spread in the 2000s, markets digitized completely. The NASDAQ became the temple of electronic trading. Every order, from a pension fund in London to a day trader in Seoul, passed through layers of software. Speed became the new currency. Firms spent hundreds of millions laying fiber optic cables and later microwave networks to cut milliseconds from transmission times. By 2007, more than half of U.S. equity trading was executed by algorithms. When the 2008 financial crisis hit, the irony was profound. The same mathematical logic that promised stability had engineered fragility. Complex derivatives, modeled on Gaussian distributions and priced by machines, imploded under assumptions that humans had stopped questioning. But the collapse also accelerated automation. Regulation thinned the ranks of human traders, while cheap computing power multiplied their algorithmic replacements. Machine learning, the ability of systems to teach themselves, arrived just as human trust in experts collapsed. By the mid-2000s, hedge funds like Two Sigma, Citadel, and Point72 were investing billions into AI research. Neural networks were trained on decades of tick-by-tick data, social media sentiment, even satellite images of factory parking lots. They detected patterns invisible to any analyst. In 2010, the flash crash revealed what that world looked like in motion. $1 trillion vanished and returned in 36 minutes, triggered by machines trading with machines. Artificial intelligence had learned not only to analyze risk, but to create it. Predictive systems began pricing bonds, ensuring mortgages and allocating credit faster than regulators could respond. In China, algorithmic trading surged through the Shanghai and Shenzhen exchanges, helping inflate the 2015 stock bubble that wiped out $5 trillion in value when it burst. In London, quant desks used AI to arbitrage Brexit rumors in microseconds. Markets were no longer reflections of human belief. They were arenas where algorithms competed for dominance. Then came the next leap: generative AI. By 2020, models capable of reading, writing, and coding entered the financial sphere. Natural language systems analyzed corporate filings, transcribed central bank speeches, and generated trading scripts. In 2021, major funds began using GPT-based tools to draft investment theses automatically. Startups offered AI co-pilots for traders, capable of scanning thousands of headlines and predicting sentiment shifts in real time. For the first time, financial interpretation itself, the art of reading the world, became a computational process. As these systems multiplied, a new kind of contagion appeared. The more AIs trained on the same datasets, the more they behaved alike. When one model sold, others followed. Feedback became synchronization. In 2022 and 2023, the collapse of algorithmically managed cryptocurrencies, first Terra USD, then FTX's cascading failure, demonstrated how interconnected machine speculation had become. Billions in digital assets evaporated not because of human greed alone, but because automated liquidation scripts triggered each other in perfect, merciless logic. Governments scrambled to keep pace. The U.S. Securities and Exchange Commission proposed mandatory audits for trading algorithms. The European Union introduced the Artificial Intelligence Act, classifying financial AIs as high-risk systems. Yet enforcement lagged behind invention. Regulators could barely understand the models they were meant to oversee. Economists coined a new term: techno-opacity, complexity so deep it becomes governance-proof. Central banks, which once guided markets with words, now competed with algorithms that responded before the sentences were finished. The cultural consequences ran even deeper. In the past, speculation was a human drama: greed, fear, euphoria, ruin. Now it was invisible. Machines didn't feel risk. They calculated it. The emotional cycle of capitalism, boom, crash, recovery, was replaced by the cold pulse of optimization. Traders became custodians of systems they no longer controlled. When asked to explain decisions, many simply shrugged. That's what the model said. Confidence had shifted from reason to replication, yet the illusion of mastery persisted. As AI systems expanded into credit scoring, hiring, and political forecasting, their reach blurred the line between economics and governance. Algorithms determined who received loans, which businesses survived, and which currencies strengthened. They didn't overthrow institutions. They absorbed them. The market had become not just digital, but autonomous. And like every empire built on code, it carried the seeds of self-destruction, homogeneity, opacity, and faith in its own perfection. By the late 2020s, artificial intelligence managed the majority of global financial flows. Sovereign wealth funds used deep learning models to rebalance trillions in assets. Central banks experimented with AI-driven digital currencies that could adjust interest rates algorithmically. Meanwhile, high-frequency systems continued to exploit microscopic inefficiencies measured in nanoseconds. The result was paradoxical. The world had never been more efficient, and never more fragile. The same precision that eliminated randomness also eliminated resilience. When everything reacts instantly, nothing can absorb shock. Three truths emerge from this evolution. First, Intelligence is not neutrality. Every algorithm carries the assumptions of its creators and their blind spots. Second, speed is not progress. A market that trades in microseconds leaves no time for reflection, only reaction. And third, trust is not programmable. Every financial system, from gold to blockchain to AI, survives only as long as people believe it reflects reality. When that belief fails, no amount of data can restore it. The AI revolution did not destroy capitalism. It perfected its logic. It turned speculation into computation, volatility into design. Yet the deeper question remains: when machines can trade, decide, and predict better than humans, what remains of human economics? Perhaps the next collapse will not come from ignorance, but from intelligence pushed past its limits, when the systems we built to manage risk become the risk itself. If this story made you see the future differently, subscribe to Economic Collapse. Because every revolution begins as progress and ends when its creators mistake precision for wisdom.